Hey everyone, welcome to our brand new segment for List Self Storage, 5 questions with, where we bring you expert insights to help you navigate the self-storage industry. I'm super excited to kick things off today with our first guest, Anita Huedepohl from Liberty Funding. Anita, thanks so much for being here.
Well, thank
And
you.
before we jump in to our questions, could you tell us a bit about yourself and what you do in
Sure.
the self-storage industry? I'm sure our audience would love to hear more about your background and how you're helping clients in this space.
Sure. I been in self-storage financing for over 20 years now, and I do loans from coast to coast, all different types of financing from SBA to conventional, bridge, occasionally hard money. Hopefully, we don't need that as often, but the market changes and people get in situations. So, pretty much run the gamut as far as availability of product and really try to cater to each individual client on a one by one basis.
Great. All right. Well, thanks so much for the introduction. All right, so we'll jump in to our first question here. Anita, what are the most common reasons self-storage operators are declined loans by traditional banks?
The most common ones I would say are debt service, which is the cash flow of the property. Either they have inaccurate accounting that makes them appear to make significantly less than they actually net, or they're not accurately reporting all their income. So oftentimes they'll go to, let's say, their local bank or their current lender, and they'll try to refinance or get additional cash out. And what they find is they look at the books strictly from a cursory level, and all they see is not non-sufficient cash flow, basically, to be able to cover the debt. And they'll decline the loan oftentimes when that happens, rather than actually digging into the books. That's usually one of the first reasons they're declined. The other one oftentimes is credit, especially if it's a sole operator, sole proprietor. They may have had challenges, especially coming out of COVID, even though it's been a few years now. A lot of operators ran into trouble with that, so their credit may have suffered. And albeit they may not have perfect credit, there's still a deal there. There's still an ability to get financed, but maybe not at the local bank where they're looking for like a 740 credit score. Even if you have a score that's in the 600s, you can still get financed.
Right. So great, you mentioned the COVID. So are there any trends in the lending criteria that have changed recently, maybe due to the economic shifts or how the industry's been performing?
I would say the key thing, of course, as we all know, the rates have come up significantly. That has affected, everyone from buying a house to refinancing your self-storage facility. Um, but typically the trend has been right now, we're starting to see rates kind of very slowly. They're starting to come down just a little bit. So I think we're headed back in the right direction. I don't know that we'll ever be in the 3% range again. But historically speaking, if you look back 20 or 30 years ago, we had rates that were plus 14 to 18%. So we're not really in that bad of a situation, especially with things coming back down. So it's really a matter of just kind of following that curve and figuring out the best product. Sometimes it's a bridge loan just to kind of get in the market, get something stable, and then wait for those rates to come back down again. Sometimes it's a permanent loan, depending on if you're buying or what your circumstances are, really.
All right. So next question, our second question, how can operators identify lenders who truly understand the unique needs of the self-storage industry?
Um, do they know what is entailed in operating, as opposed to, let's say you have an apartment complex, which they get plenty of those in. Self-storage is such a unique niche type product. They really have to understand, like, is it kiosk operated? Does it have remote gates? Does it have storage for RVs and boats? There are a lot of components that come into self-storage that you're not going to find in your typical CRE, commercial real estate loan, that the loan officer, not just the institution can say that they're doing self-storage loans, but that doesn't mean that the loan officer understands them. And it's all in who delivers that package to underwriting and how well they understood what they're conveying to underwriting as to whether or not it gets approved. I've had loans where I've had people come to me, and I actually had one last year, and she told me she had been a year and a half at a very well respected lender, national lender, a year and a half waiting to get approved. And I said,
Oh my
that's not
goodness.
normal. I said, it's normally about 30 to 60 days, but that is definitely, and she was shocked because she had believed them 1,000% and ended up getting declined after a year and a half. I got her approved. I got her approved within 30 days. So
Wow.
it's all in who's presenting and how they understand that particular property type.
And you mentioned that. Do you see a growing trend of industry specific lenders? And you know, how
Oh,
do they compare
definitely.
to traditional
Es-
banks? Obviously, yeah, like you
es-
mentioned, it's a very, very specific industry, very different metrics you're looking at.
yes. And I would say specifically, albeit a lot of conventional lenders are now coming into this sector, SBA has really ramped up to be able to accommodate self-storage, get them over that hurdle, also do some construction, whether it's rehab or it's ground up. They are really gunning for that particular product type. They love self-storage. So there's definitely product out there. And right now with the market, obviously, again, rates are up, but overall, there are still some great products out there.
Right, right, right. All right, on to our third question. Can you explain the concept of add back expenses and how they can impact loan approval for self-storage facilities?
Sure, of course. The biggest thing with add backs is if you look at, let's just say, a standard profit and loss statement out of QuickBooks, and you see a bottom line that's in the red. Well, if you go back through line items and you see significant amounts, let's say like I always look for things that are over $10,000 just to really clue into what I can add back into that bottom line. I don't look at things that are like $100 or $300. That doesn't matter. Look at things that are above 10. Let's say that you had to go back and you had to replace all the sprinklers on the lawns on the property, and that cost you $20,000 last year. But that was a one-time expense. Historically, for your property, it's only going to happen maybe once every 20 years, if that, depending on your climate. So you can add back for that expense to the bottom line. Well, there's one. And let's say you were negative, I don't know, $25,000. So let's add that 10 back into the bottom line. So you're now negative 15, but you also spent $45,000 renovating part of the property, and that was cash out of your pocket. Well, there you go. Now you're in the black. All these one-time expenses that are extraordinary can put you in the right place to get approved, as long as you understand the dynamic of one-time expenses.
And I'm assuming it takes someone that knows obviously about the industry like yourself
Yeah,
to really pinpoint those expenses and say these can be added back.
of course.
A
Again,
traditional
it's
bank wouldn't look at that and
they wouldn't take the time. They would, unfortunately, banks are awesome, don't get me wrong, but they have a box and they're
right.
targeting the people that will fit specifically in that box. They're typically 740 plus credit scores. They have a ton of money in the bank and they have a perfectly operating portfolio. They're not typically your small business mom and pop, if you will, type operators. But you know what? The unfortunate part about that is they don't listen to what the story is. And oftentimes, if you listen to what people are really telling you, and even if they're not perfect in black and white on paper, if you really sit down and listen to what their problem is, you can figure it out and you can help them get approved. And that's the art of what we do as brokers, is that we will go in and figure out how to make that deal get approved, where these poor people sometimes have been turned down, oftentimes multiple times. And then they come to me or someone like me that's, hopefully listening to what they're really saying. And the best part of that is when you close, it's the best feeling in the world because you're really helping somebody.
Right. Well, that's great. All right. Fourth question. What advice would you give to an operator who has been declined a loan but believes their facility has strong growth potential?
Put together a resume that makes you look like a rock star. Show me all the experience you have in self storage. That's one big mistake people don't do. They don't put together a great resume. Number two, have a great business plan with wonderful projections that are accurate based on area comps. And let's say that they're building one or they're renovating one, and their numbers aren't there yet, but they know that there is a college campus that's expanding, or a military base, or an apartment complex that perhaps is coming into the area. And maybe the local recreational area, like a lake, is expecting to expand on the ability to have RVs and all that seasonal, but they need storage for those RVs in the off season. Those are things that only people that live in that area will recognize. And if they put that on paper for an underwriter that maybe is 3 states away, they're going to get approved. They just have to put it on paper and make the story look good.
Yeah, that's very important. All right, so last question, how do different loan types like SBA or bridge loans compare in terms of benefits for storage operators?
Well, it really depends on circumstance. SBA is great for high leverage. They do a lot of ground up construction, and they also will do renovation work. Bridge loans are designed for, let's say that your note is coming due, and let's just say, for instance, it's coming due in 3 months, but you don't know that the market is going to shift, like we were speaking of earlier, where rates are starting to come down. But perhaps with the note coming due, they don't want to renew it, and you still want to ride out the wave until you can get a much lower rate. Bridge is perfect because it gives you like 12 months of consistent payments to make. You retain the property, and then probably within that 6 month time frame I would start to look at where rates are going and start to hunt for the new lender that can give you the rate that you were really after but weren't sure of because of the market volatility.
Right, right. Well, great. That concludes our 5 questions with Anita. Thank you for your time today. Now, before we leave, how can our audience get in touch with you if they have questions?
Give me a call. I love to talk to folks. I'm at 615-417-4710. And you can also email me, Anita at libertynationwide.com. But love to get phone calls because I love to hear the stories and try to help folks get closed.
That's great. Well, thank you for your time today, Anita. And everyone, just be in touch every month for our new segment, 5 Questions with. Thank you so much for joining. Bye.
Thank you.